Happy Wednesday out there, Team 42. It's your skipper here, Darius Dale, to present our macro minute for Wednesday, January 3rd, 2024. Happy New Year to everyone. Hope everyone's had a wonderful holiday weekend. Looking forward to getting after it and supporting you guys on the research and risk management front throughout 2024. So we'll start, as always, with our executive summary from today's leadoff morning note. Number one, so if you want the analysis, obviously supporting these conclusions as well as what to do about them specifically in your portfolio, you obviously need to be a client 42 macros. So number one, the global manufacturing downturn, which began in the summer of 2022, is showing signs of bottoming. Specifically, core global manufacturing economies like China, Italy, Germany, the Eurozone, and Switzerland all saw their manufacturing PMIs improve on a sequential basis in December. Number two, showing signs of bottoming is not the same thing as demonstrating a clear recovery. However, as most other economies saw their manufacturing PMIs decline further into contraction territory last month, specifically Australia, Japan, Spain, France, UK, Brazil, and Canada. And lastly, number three, investors would be remiss to anticipate a manufacturing boom over the medium term. What is more likely to happen is a gradual recovery throughout 2024 as the lagged impact of easing financial conditions globally supports the global goods production and consumption. Transitioning to my 42 macro dashboard here. We've been talking about this for the past few days here on the program, but we're still getting oversold signals here on the short side, on the oversold signals in long-term interest rates, 10-year nominal Treasury yields. So we should be expecting some backup across the Treasury curve, and we're obviously experiencing that on a week-to-date basis. So just be aware of that. And then transitioning to our 42 macro aware community, addressing a question from one of our subscribers this morning, saying the question is trying to understand how to use both the macro weather model and our volatility adjusted momentum signal to put on position sizing in terms of their positioning sizing process. So I'll just read the question verbatim. I work full time and don't have lots of time on my hands for trading. So running just 4 assets, stock market, bond market, Bitcoin, and cash is simple and manageable for me. He's referring to our KISS portfolio construction process, which many of you guys are all obviously using to help manage your portfolio risk. We appreciate that because it's obviously working. But I don't understand how to combine the position sizing from the macro weather model and VAMs. And so any advice for me? So that's pretty it's pretty clearly indicated in terms of our KISS portfolio construction process. So what we use in terms of the top-down and bottom-up risk management overlays that are featured in that process, which is the real, the secret sauce of the process that allows it to outperform your 60-40 portfolio over the medium and long term. And so in terms of the top-down risk management overlay, we use our macro weather model to incorporate volatility targeting into that process. And so how we do it, it's sort of like a dial. Think of this like a dial as you would, going from hot, cold, or, hot to mild to cold in your living room or something like that. So for example, if the weather model signal for the stock market is bullish, then the target exposure for the S&P 500 is 60% in that 60-30-10 portfolio. If the weather model signal for the stock market is neutral, then the target exposure for the SPY ETF is 50%, so it's dialed down 1,000 basis points. And then lastly, if the weather model composite signal for the stock market is bearish, then the target exposure for the SPY dials down another 1,000 basis points to 40%. And so this is trying to design to incorporate vol targeting into our 60-30-10 trend following strategy. So what effectively it's doing is saying, hey, when the weather model is telling you that it's a good time to be invested in stocks over the next 3 months, then you should be fully invested, or at least the target exposure should be fully invested, and so on and so forth, going from fully to neutral to light, 60, 50, 40. The bottom-up risk management overlay is driven by our volatility adjusted momentum signal at the actual exposure level. So, for example, sticking with stocks, if the SPY ETF is bullish from the perspective of our volatility adjusted momentum signal, then the actual exposure is equivalent to the target exposure. And so the actual exposure can be equivalent to the target exposure. It can be half of the target exposure, or it can be 0% based on the volatility adjusted momentum signal. And so, if the neutral if the SPY ETF is neutral, then it'll be the actual exposure will equal 50% of that prescribed target exposure from the top-down risk management overlay. And if the ETF is bearish VAMs, then the actual exposure equals 0% of that prescribed target exposure. So, for example, just give you a few examples. Let's say the stock market signal, the composite signal for the stock market in the weather model is bullish. Then you have a target exposure of 60%. But let's say the SPY ETF happened to be bearish at that particular time, then the actual exposure will equal 0%. So even though you have a target exposure of 60, the actual exposure is 0% because the SPY ETF is bearish. Conversely, you could have a situation where the target exposure for the stock market is bearish, which means the target exposure is 40%, but the SPY ETF itself is bullish, which means the actual exposure equals 100% of that 40%. And so again, we're using in terms of the bottom-up risk management overlay, that volatile adjusted momentum signal infuses dynamic position sizing into our 60-30-10 trend following strategy. So it's really just about, if you're going to follow KISS at home, obviously all this information is communicated right there every time you see any updates to that portfolio construction process. But generally speaking, if you're going to create your own customized version of KISS, which we highly recommend folks do, to the extent that that KISS is a great sort of setup. The baseline KISS portfolio is a great setup for you based on your own risk tolerance or your age or your liquidity preferences. Then you can swap out different exposures, and we produce all the information you need to swap out different exposures whenever you see an update from us in terms of our lead off morning note or around the horn. So we'll wrap it up there. Thanks again for the great question. Having a great time interacting with our subscribers and our 42 Macro Aware community. It's a real safe, wonderful space for learning, and we're really grateful for that and grateful for all the participation. So we'll catch you back here same time tomorrow. Everyone have a wonderful day. Best of luck out there and have a great week. Cheers.